Get that done. So we're going to go over first-time home buyer. We're going to actually walk through a first-time home buyer webinar. And the whole point of that is to make sure that, or to actually present to you what a first-time home buyer webinar looks like. And then you can take this out to your clients and you can present this webinar, or you can have me present this webinar. Either one works. But what we're going to do is we're actually going to go through the full presentation, and this presentation can be condensed. It can be reworked in a number of different ways. But we want to make sure that we're actually going through the whole thing so you get a full view of what the full presentation looks like. And then you can take this out again to your clientele and make sure that you're capturing this really important business. I mean, right now, first-time home buyers are a big market, and moving forward with millennial generation, Gen Z after that, it's going to be a big market for a long time to come. And it's a great way to build business, because if you can get somebody into their first house, you can build a client for life. So we're going to kind of jump right into it. So we're going to present this actually as I'm presenting it to a first-time home buyer audience. So it's not really geared, this presentation won't be geared toward realtors directly, but think of it as I'm presenting this to first-time home buyers. So I want to welcome everybody. We want to thank you for attending and creating wealth through homeownership. We're going to walk you through a guide to buying your first home. And you can see that I'm Ken Watson, the branch manager with Neil Home Loans. And then we have Ruby Realtor on the call, who is also, Ruby is the agent that we're presenting for here. And so you can see a little bit of information about Ruby and what she likes to do. She was licensed in 2008. She grew up in the foothills outside of Los Angeles. She's a hiking enthusiast and loves to teach her clients about real estate. So we want to welcome Ruby's clients here, and we're going to actually walk through this and teach you what you need to know in order to get your first house. So the first questions we have for the audience is, do you think the home prices will go up or go down over the next 5 years? And the next question would be, do you think interest rates will go up or down over the next 5 years? And then these are a lot of questions that you would have as a potential homeowner, is these two questions. We're going to kind of get into that a little bit. Do you think it will be less expensive to make a mortgage payment or a rent payment over the next 10 years? We're actually going to walk through an example on that and show you the difference between making a mortgage payment and making a rent payment. So the first thing we need to understand, though, as a potential homeowner out there, you may be renting right now and you're seeing a lot of the headlines and you're wondering, man, what is going on? Is this the right time to buy a house? Is it not the right time to buy a house? You get a lot of negative news out there, and that's part of the problem. We don't really have a housing crisis as you're seeing in the news. We have more of an information crisis, and we need to be able to present facts to you so you understand that what the media is telling you and what's actually happening in the housing market are two different things. So we have you as a consumer have a confidence crisis right now because of all this negative news. And you can see that when we take a look at people who believe it's a good time to buy a home. It's decreased in last year from 19% to 16%. And do you think it's a good time to sell a home? That actually decreased from 59 to 51%. And people who believe home prices will go up in the next 12 months actually dropped from 32% to 30%. And people who believe mortgage rates will go down in the next 12 months decrease from 9% to 6%. So you can see that as a consumer, we're losing confidence in the housing market, and we really shouldn't. So let's walk through some of the things that we need to really figure out what's really going on in the housing market. So as a potential homeowner, you understand really why it's a good time to buy a house, and we're going to present to you facts as to why. So builders haven't been able to catch up. You can see in 2008, we had a lot of inventory, and then it just dropped off the map because of the housing market crash. And we've been trying to catch up ever since, and we haven't quite gotten there. So there's not enough homes in the market for sale as to what the demand currently is. Inventory is still drastically low, as we talked about, almost 4 million homes for sale before the housing market crashed, about 1.28 million now. What that creates is, in the law of supply and demand, if you have more supply or less supply and more demand, then home prices are going to go up, right? So in 2008, we had more supply and less demand, home prices crashed. currently we have more demand and less supply. So that's supportive of home prices. So that's something the media is not really giving you. You can see here that between the millennial and Gen X generation, there's 130 million people that are aging into home ownership, meaning you typically purchase your first house in the age of 32, 33 years. And you can see here between the millennial generation and post-millennial generation, here's where we are today. There's a lot of people that are going to be looking for homes to purchase over the next 10, 15 years. So demand is still going to be there. So you're going to be out there when you're looking at homes competing with a lot of people that are looking to purchase homes as well moving forward in the future. Credit availability is historically low, and that's a good thing. What the point is that back in the day before the housing market crash, there was a lot of risk in the market because of a lot of exotic loans. And we don't have that today. Most people are purchasing and utilizing a 30-year fixed rate mortgage, meaning you're paying your mortgage down. It's a very safe environment. It's a very stable environment. And that creates a very stable housing market as well. So the fact for the last 10 years, we have not done really any risky loans means the housing market, underlying housing market is really strong actually. And foreclosures are up, but they're still at record lows. So you can see back in the housing market crash, we had a lot of foreclosure activity that dropped down. And you can see here that while foreclosures are up, and if you listen to the media, they're screaming foreclosures are up 150%, 200%. Well, of course they are, because in 2020 and 21, we had restrictions on foreclosures because of COVID. Once those restrictions were lifted, it's natural to have that number move up a little bit. But you can see by the number of foreclosures right now, it's historically low compared to years past. We have a lot of equity in the market, $2.2 trillion in equity as of Q3 2022. What that means is that's going to keep that foreclosure rate down. They're not going to see a lot of foreclosures out there. A lot of people are sitting on equity. So again, that lends to a very stable and strong housing market moving forward. And then we also have mortgage rates dropping down. They tend to drop through recessions. You can see that they moved up a little bit in this recession, but then dropped down. Recession dropped down, recession came down again, and again. So we expect a recession to be coming forward here, but as a future homeowner, I wouldn't let that stress you out, because recessions are actually good for housing and mortgage rates. We see by this chart, mortgage rates drop through recessions, and we expect mortgage rates to move down in the 5% range later on this year. And you can see here that inflation, mortgage rates will typically follow inflation. At this point, as inflation moved up, mortgage rates kind of went sideways because the Fed was kind of keeping their thumb on the scale. But once the Federal Reserve let go of that, mortgage rates followed inflation up. And as it's turning over here, we're seeing the turnover in mortgage rates as well. So bottom line is mortgage rates are starting to come down, inflation starting to come down. We expect that pattern to follow forward into this year and into the fall. So expect to see mortgage rates again move down into the spring and summer and fall. And home prices typically appreciate through a recession. The only time they didn't was the housing market crash, because the housing market caused the recession. However, in every other recession, home prices have either stayed flat or actually moved up during a recession. So right now, if we do have a recession coming forward, home prices will probably increase up through that recession. So again, a stable housing market, contrary to what you're seeing and hearing in the media. And we need to make sure that we're letting you know that it's still a great time to buy. And let's talk about what the media does. So over the last 7 years, you can see a lot of these headlines were pretty negative in the media. But if you would have purchased a house at $315,000 7 years ago, you would have had equity and appreciation increases every year to the point you would have lost $222,000 in equity if you hadn't purchased in 2015. So from 2015 to July 2021, it would have been a good buy to purchase a house, and look at all the equity you would have gained. But if you would have listened to the media would have told you it's a horrible time to buy a house. Don't buy a house. You should keep renting, and you would have lost out on this much money in equity. So let's talk about the pros and cons of renting versus buying. So if you rent, one of the pros is you have no maintenance. That means the owner of the property, the landlord, they maintain the maintenance for you. So if you have an issue, you just call them, they fix it. It's easier to move and relocate. If you want to move, give your 30 days notice, pack up your stuff and move someplace else. The cons are the monthly payment isn't fixed. So every year your rent's moving up or has the potential to move up, and to the tune of sometimes between 5 and 10% annually. No tax advantages. So you don't have any advantage of paying rent and being able to write that off in your taxes. You have more rules. You're at the mercy of the owner or the landlord. You can't just do whatever you want to the property. When you move, you hope to get your deposit back within 30 days. It's not guaranteed that would happen. And your money goes into someone else's pocket instead of yours. You're creating wealth for them while diminishing your own wealth. So those are the pros and cons of renting. Let's take a look at buying. So the pros of buying are monthly payment is fixed, except for taxes and insurance and HOA dues. Those can change a little bit over time, but they're pretty stable. So what you get is a linear sideways pattern on your payment for the most part. You have a potential tax write-offs through interest and discount points and other things that you can write off. You have pride of home ownership. You get to set the rules. Your home is your blank canvas. So that means that you can do the flooring any kind you want, the color what you want to do. If you want to swap out your appliances for different appliances, you can do that. So you have a lot of autonomy as to the pride of homeownership. The only time you may not is if you're in a condo situation where you have a homeowners association. There's some restrictions there, but for the most part, you can do what you want with the property. Long-term investment. So if you think about it as long-term investment, when you sell, you'll more than likely have a good equity position. You're able to leverage your home's market value to make other investments. So if you want to purchase an investment property or a second home, you can tap into the equity to do that. Or you can upgrade to a nicer home. So you can sell the property, take the equity that you've gained and add that to the down payment on the new property. So the bottom line is you're creating your own wealth as opposed to somebody else's wealth. The cons are there's more maintenance required and it can be expensive, but a lot of that can be mitigated if you're put together, for instance, a home warranty plan, and your realtor and myself, we can help you with that. It's not as easy to relocate. So, it's not just, hey, 30 days notice, I'm out. There's a little bit more you have to do, but it's not so bad. You would just contact myself and your realtor. And at that point, we would then put together a plan for you to relocate and what a timeline what that would look like. So while it's a little bit more difficult, it's really not that bad. So let's take a look at some of the math. The average rent in the United States currently is about $2,007 for a two-bedroom house in the top 50 largest cities. And according to iPropertyManagement.com, the average rent increase annually is 8.85%. But we're just going to knock that down to 8% and utilize that over the next 5 years and see what it would cost you. So you start out at $207 a month, and then it goes up to $2,168 and $2,341 in year 3. In year 4, you're at $2,528, and finally at year 5, you're at $2,730 a month. Now you can see to the column to the right, if you multiply that out annually, what the increase is. So the total rent paid after 5 years is $141,288. That's a lot of money to be putting out on rent and creating wealth for somebody else. So let's do a case study. So our first case study is going to be an FHA loan for 3.5% down. These programs work great if you have minimum down payment or minimum money for down payment. And also if your credit score is a little bit lower, FHA is a great loan to take a look at. So here's the math. The median home price right now, we're just going to utilize median home prices because we can tailor this to whatever market your realtor in or you're in. But currently, the median home price nationwide is $454,900 as of Q3 of 2022. So if we use a minimum down payment of 3.5%, your down payment's $15,921. And let's say we have to add closing costs in, and you have to have money for setting up impound accounts for taxes and insurance. So roughly about $35,000 total with your down payment and closing costs. At 6.5% interest rate, which is about the going rate in today's market, your payment would be approximately $3,654, and that's including your taxes and insurance and mortgage insurance. So if you took that $15,921 for down payment and invested at 8% over 5 years, you'd have about $34,982. However, if you purchased a property, your net worth in your home over the next 5 years would be approximately $153,290. So let's walk through that. So you can see here, if you have rent, here we have the rent of $2,007 plus $54 in insurance, renter's insurance that you would normally have. So your total payment every month is about $2,061. So if you had a 6.5% interest rate, putting 3.5% down, you can see that your payment would be $36.54 per month, but you get a tax benefit. If you're in a 22% bracket, you get a tax benefit about $865 a month. And every month you're averaging about $397 per month going to pay the principal on your mortgage, paying that down. So really what your net monthly payment is, which would be equivalent to rent, is about $2,392. Now, there's a program out there called a 2-1 buy down. We're going to talk about that a little bit later, but just real briefly, it means that we can take some of the seller's money, get a credit from the seller when we negotiate the price for the property, to allow you to have a lower rate for the first 2 years alone. So in a 2-1 buy down, your first year, you would have a 2% lower rate than the going rate. So if the going rate is 6.5%, it would be 4.5% the first year, 5.5% the second year, and then in year 3, it would go up to the 6.5%. If we were able to utilize that strategy, we can then have a payment that's about $571 per month less than the 6.5% rate. So you can see that your net rate's $1,820, which is less than your current rate now. So that's a great program that we can utilize, and we can talk about that when you do a pre-approval process and maybe work that out on the purchase of your house. So let's talk about rent versus principal paid over a 5-year period. So you can see in 5 years, you're paying over about $145,000 in rent, but in that same time frame, in each one of these other scenarios, you've gained about $28,000 in amortization by paying your mortgage down, and then $38,000 in the 2-to-1 buy down. So you can actually create wealth. You're creating more wealth by owning, and $145,000 of just money going out the door by renting. So your net worth, which includes your amortization and also appreciation on the property, over a 5-year period is about $142,500 and $153,000 roughly for the 2-to-1 buy down. So what that means is, when you take a look at how much, if you're renting, you have zero net worth, that money's going out the door. However, with FHA and the 2-1 buy down, you're gaining not only in amortization, but you're also gaining in appreciation. And we can kind of see that on this next slide. So here's your rent payments going out the door. Here's how much you would totally paid on both of these mortgages, on both these scenarios. Here's the principal you would have paid down. Here's your tax benefit. And here's the net cost. So you can see the net cost across the board is about the same when it comes to renting versus the 6.5% rate. However, on the 2-to-1 buy down, it's less. But here's where your real value comes in. Your real estate has increased now to $554,000 roughly. So you've actually increased your appreciation on the property, and your loan balance has been paid down by making your mortgage payments. So here's your total equity position on each one of these scenarios. That's your net worth. That's how much wealth you've created for yourself in that 5-year period, as opposed to renting by purchasing a house. Let's take a look at case study number 2, which is a conventional loan, 5% down. So this would be a Fannie Mae or Freddie Mac loan. So these are really good loans for people that have credit scores of, say, 700 or higher. And let's take a look at what that would look like. So we're going to take a look at a home in Weatherford, Texas, which would be $575,000 for about a 2,500 or 2,600 square foot house. And the reason we picked this is just because it's typical of a house in the Midwest, in the heartland. So we're just trying to get an idea of kind of, nationwide, what a community like that would look like. So minimum down payment of 5%, approximately $28,750 down payment, and cash to close with closing costs, roughly about $42,000. So at 5% interest rate projected, the average rate we're going to use a 5% interest rate, because that's a projected average rate in 2023. That's where we think rates are heading. So we're going to use a 5% interest rate for this scenario. And your mortgage payment would be approximately $4,267, including taxes and insurance and mortgage insurance. If you took that $28,750 and invested it somewhere else for your down payment, in 5 years, you'd have about $42,243. So let's kind of look at the details of this. The average rent in Parker County, which is where Weatherford's located, is about $36.23 for a 2,500 square foot property. You have renter's insurance of $54 per month. And you have an average annual rent increase in Parker County of about 5%. So we're going to purchase the property for $575,000, roughly about $9,300 for taxes annually. Your insurance would cost about $168 a month. And let's assume about $95 for repair cost spread out over the term of how long you own that property. Maybe you upgrade some things, you have some maintenance you have to do, that type of thing. So our new loan would be at 5% down. Our new loan would be $546,250, 30-year fixed. And then we have a 5% mortgage rate. And we have about $300 in mortgage insurance, and we have our closing costs. So the historical appreciation in Parker County over a 10-year period, we're going to look out over a 10-year period, and the historical appreciation rate is 3.82%. So that's the number we're going to use for appreciation on the property. Very conservative number. And again, it's historical. So it's something we can look back on in this county and say, this is what it averages out over a period of time, say 20 years. So when we take a look at renting and buying in year one, you can see the breakdown of the payment for the mortgage, which is buying year one. And you can see the total cost, $4,267. And then in year one, your rent with your rent payment, your renter's insurance, roughly about $3,677 per month. And then you can see as we amortize out to 10 years, how much your payment goes up at a 5% in annual rent increase. So in 10 years, that $3,600 payment moves into a $5,700 payment. So if we look at these bars over here, if we take a look at year one, year two, year three, year four, it's going to be a little bit less expensive to rent. However, in year five, your rent actually increases to the point where now the mortgage is less expensive. And again, year 6, 7, 8, 9, 10, you can see how rent in these purple bars just moves up, but your mortgage payment is linear. It stays about the same because the only thing changing in that is taxes, insurance, and maybe an HOA payment. So your cash flow over the 10-year period is actually $32,500 roughly better by purchasing than renting, because that payment is going sideways and your rent payment is going up. But that's only part of the story. And that's where most people stop, is just comparing a mortgage payment to a rent payment. But in order to really get an idea if purchasing is best for you and how to create wealth, we really need to dive a little bit deeper in the numbers. So let's take a look at your appreciation gain. So you can see up top, we have the same slide we saw earlier, but now we've added appreciation gain. So you can see that you purchased the home for $575,000. And if we use the historical appreciation in Parker County of 3.82, that property in 10 years should be worth about $836 or $836,000. That's a $261,000 appreciation. On top of that, you have amortization gain. What that means is every month you're making your mortgage payment, you're paying down a portion of the principal with the payment. So if you started out with a $546,250 loan, after 10 years, it's going to be $444,000, meaning you had $102,000 you paid down just in amortization gain just by paying your mortgage payment every month. That's a forced savings plan. So that's like putting money in the bank every month. It's going into your equity. Now, after 10 years, if you decide to sell the house, there's going to be a cost to that. We want to account for that. So roughly $67,000 to sell the house. And that includes 6% maybe realtor commissions plus 2% in closing costs. So you can see that there's a cost to that. There's also a tax benefit. If you're in a 22% tax bracket, over 10 years, you're going to see a net tax benefit of about $20,140. So when we take a look at the whole picture, yes, there's some closing costs, there are some costs to sell, but you've made up money and not renting. You've appreciated, you have some appreciation gain, about $262,000. You have about $102,000 in amortization gain, and you have your tax benefit. Your net gain by buying a house in this scenario is about $337,000. So over a 10-year period, that's how much wealth you've created for yourself as opposed to renting. So let's take a look at it another way. You purchased the house for $575,000. Over 10 years, you've paid $553,316 in rent, including the rent increases. By purchasing, you would have created $337,000 in wealth, as we just demonstrated. So the total wealth lost by renting is $890,000 when you combine the lost wealth of purchasing plus the rent you paid. So if you look at it another way, in 11 years, you would have paid more in rent than the original cost of the home. So again, you can really create wealth by purchasing. By renting, it's really difficult to create wealth. So let's kind of break it down again. If you continue to rent, your rent would increase over the next 10 years. Total rent paid is $553,000, as we just talked about. And instead of buying a home, you elected to invest that $23,480 at an 8% rate of return over a 10-year period. You'd have $50,691 in your pocket. By buying a home, it's a clear winner in the long term because you get a monthly payment that today is $590 more expensive, but in 10 years will be $1,437 cheaper than renting. In 10 years, you would have paid down your mortgage by about $102,000 and your property appreciated by about $262,000. And again, overall equity and wealth created was $337,000. So again, buying is a great way to create wealth and to hedge against the inflation of renting on a monthly basis. So at this point is where we would ask questions of the audience. If anybody had any questions, we would take some on this. But let's assume we don't have any questions right now. Let's move into the home buying journey. So now that we've shown you as a potential homeowner or potential buyer that it's a good idea for you to maybe purchase a house to create wealth for yourself and to hedge against future shelter costs, what does that journey look like? How does it work? So first off, the first thing you need to do is get pre-approved. So before you do anything, you would want to contact your lender. You can work with me if you like and get pre-approved. And once that pre-approval is done and we know how much you can purchase, how much your payment would be, does that payment fit your budget? There's a lot of things we look at in that pre-approval process. It's not just a quick process. We want to make sure that you are going to be a successful homeowner. So there's a lot that goes into that pre-approval process to make sure that we're putting you in the right position. Next thing we do is have you connect with your realtor, in this case, Ruby Realtor, our example realtor, to develop your needs list and your search criteria. So you'd sit down with her and talk about what your likes are, what your dislikes are, where you want to live, what criteria you want in your house. So these are very important conversations to have with your realtor. Once those are done, then you go out and make an offer on property. So you go out and look at properties and start to make offers on properties. Let's say you find a property, you start to get in negotiations and you do some counter offers back and forth. And finally, the seller says, yes, I'm going to take your offer. Now you go under contract. Within 24 hours, you're going to have a contract meeting with myself and your realtor. We're going to go through every aspect of that contract, what the timelines are, what the timeframes are, what your responsibilities are, what our responsibilities are. And we're going to make sure that everybody is very clear moving forward as we go into the escrow process. So that contract meeting is a very key component to your journey to home ownership. The next step is you then wire money to escrow. And at that point, and that would be your down payment, or actually your earnest money deposit. It's called an EMD, or earnest money deposit. You would wire that to escrow. That's a percentage of how much your down payment needs to be. And it's determined in the negotiation process with the seller. And then we would also order the appraisal at that point on that property. The next step is schedule and complete inspection. So you work with your realtor, in this case, Ruby Realtor, and she would schedule her inspections. And then once those inspections come back, if there's any repairs that need to be done, she would negotiate for that. And then we would get into underwriting. And then once we do that, we get your underwriting approval. And then we make sure that there's any conditions we have to meet. We make sure that we do that. And then we also get your appraisal back around the same time frame and get that reviewed by the underwriting department. Now, let's say everything's done. We reviewed it. And the underwriter approves everything. We signed off and all. Now we draw your loan documents and have you sign them, and you perform a final walkthrough. And then once that's done, we close and record the loan. And now you own a home. So congratulations. So basically that's the home ownership journey. That's how you walk through buying a home. Let's break it down a little bit further into the process of once you go under contract. Here's your in contract timeline. Deliver your earnest money deposit to escrow. You set up your home inspections. Your lender orders your appraisal and submits your file to underwriting. We review your underwriting approval, deliver your final document request for final underwriting, do the final walkthrough of your home to make sure that, once we're getting close to closing, you do that final walkthrough with your realtor to make sure everything is still the same as it was at the beginning of the process. The lender sends your final numbers and sets up a wire to the title company. We have you sign your loan documents, and then you get your keys. So that's basically the process when we get into contract. So some pitfalls to avoid. Real estate pitfalls to avoid. Make sure that you or the person that you're purchasing the home with are all on the same page. You want to make sure that with regards to wants and needs and monthly payments, everybody needs to be on the same page. It's very difficult if people are on two different pages. It really puts a lot of stress on your realtor. So make sure that everybody's on the same page as to type of home you're looking at, what you want on a home, your monthly payments, that type of thing. Looking at homes in person before you're pre-approved always leads to disappointment. So before you get out there and start looking at properties, make sure you get your pre-approval done. If you don't do that and you fall in love with a house that maybe you can't afford, you're just going to set yourself up for disappointment. So make sure that you get the pre-approval done and then go look at homes. Having too many friends or family members involved can really cloud the process. So make sure that you're keeping that to a minimum. If you need a mentor, someone to help you in this decision-making process of purchasing a house, narrow it down to one or two people. Maybe it's your parents, or maybe it's a close friend or a sibling. But make sure that you narrow that down, who you're counting on, and then make sure that your realtor and your lender are also involved in talking to that person as well, so they can help you make the right decisions. It's best to preview a home with everyone involved. So if you're purchasing the house with multiple people, make sure that everyone goes and sees those showings so that no one is disappointed by not seeing the house. Now, what are some mortgage pitfalls to avoid? When you actually get your pre-approval done, don't add any new debts or run your credit once approved. We want to make sure that we keep everything the same for that time frame that you're out looking at a house. So if, for instance, you go to the store or you go to a department store and then something's on sale and they say, hey, we'll give you an extra 10% off if you open up one of our cards, and you say, yeah, sure. Well, that could be a problem. So don't do that. Make sure that if you have any things you need to do, contact your lender first and have those conversations. Don't change your jobs or your structure of income. In other words, don't go from being an employee somewhere and then deciding to open your own company and be self-employed. That can be an issue. Don't spend or move your assets. So your money that's in your bank accounts, make sure that you're keeping those in place and you're not moving them around, and make sure that you're not, liquidating those assets in order to do something else. If it seems like it'll alter your financial picture in any way, don't do it. Make sure you have a conversation with your lender over it. All right, so let's understand some of your loan options. So loan options have changed over the years, but think of a mortgage like you're lending your own money. That's the best way I can tell you. If banks and investors are looking for a high probability you won't default in your loan and you won't make your payments, we want you to make your payments. We want to put you in a successful position. So there's three major components to your financial profile that we're going to analyze to decide how much you can qualify for and how much you can be approved for to borrow. One is credit. Number two is income, and number three is assets. Those are the top three things that we're going to take a look at for you. So with your credit, typically need to score a 620 or higher. Some programs will allow you to go a bit lower. You're looking for on-time payments to creditors. Okay, so when we look at your credit, we want to make sure that you're making your payments on time and don't have, you may be able to get away with one or two late payments, but we want to make sure you're making your payments. Try to make sure your payments are all paid on time. Responsible use of revolving debt. Normally like to see no more than 30%. If it's more than that, that's okay. But normally, if your use of revolving debt is 30% of the limit on that card, your credit score is going to be higher. So that's one of the things we take a look at. If you've had any bankruptcies in the past or foreclosures, short sales, if you've owned homes in the past and had some issues, they all have a waiting period before you can purchase. Now, the one that's the shortest is FHA for 2 years. So we could look at that if it's been, a shorter amount of time. If it's been longer, there's other products to look at. It affects your interest rate and mortgage insurance percentage as far as your credit's concerned. So in general, the higher the credit score, the less of the cost is going to be from the mortgage. So credit is important. We want to make sure we're monitoring it. We want to make sure we're keeping it intact. Your income, and lenders and investors are looking for stability and continuance. So the longer you've been on your job, the better. W-2 income can generally be used as far as your base pay. If you receive commission or bonus, or if you have a second job, we're going to need a 2-year average of that in order to use it. So just keep that in mind. If you're self-employed, if you're a sole proprietor, we're just going to look at your Schedule C, which is basically a glorified profit and loss statement, and that's on your personal returns. If you have a business, we're going to underwrite the business tax returns, and we'll need to analyze those as well. So we're going to need those for a 2-year average. The possibility of 1-year average, depending on the program that we use as well, and how long you've been self-employed. We determine your gross wages, and from there, your total budget by subtracting your liabilities. In other words, how much your payments are in your credit report against your income. And typically we can go anywhere from 45 to 50% of gross wages minus the liabilities. This is known as your debt to income ratio. However, if you're in a jumbo situation, that number could actually be lower, about 43%. If it's FHA, we may be able to expand that out a little bit. Same thing with VA, maybe a little bit above that 50%. So every program is a little bit different, but basically what you're looking at is, we want to make sure that what's on your credit report, as far as your payments are concerned, plus the new mortgage payment, all fits underneath a 50% number. That would be a good rule of thumb. Your assets, looking to determine if you have sufficient liquidity, meaning can you get access to those funds to pay down, to make your down payment and closing costs and escrow account. So liquidity or access to funds comes in many sources, including checking and savings account, brokerage accounts, and stocks and bonds. You can have a gift from your parents, grandparents, children, maybe a fiance, sibling. Gift of equity, if you're purchasing a property that's in the family, we may be able to utilize a gift equity. Loans from a 401k or retirement account can be utilized. We can talk about those and how that works. Down payment assistance programs, there's some out there. Most of them are income-based, meaning you have to qualify from an income standpoint. And a lot of times they don't always work in some markets. In other markets, they work well. Employer, sometimes your employer has a benefits program a lot of people don't know about, where they'll give you X amount of dollars to purchase on a down payment for a house. So that's something to keep in mind. In the sale of other non-liquid assets, we can utilize that, such as a car, boat, recreational vehicle. I had a client that sold artwork one time. We have to document that paper trail. So in other words, we need receipts for the sale, and then also document that money going into accounts. So just a paper trail is really key on that. The types of loan programs out there. So conventional loans are Fannie Mae, Freddie Mac products. You may have heard those names before. They're the most common product used out there. You could put as little as 3% down for first-time home buyers and 5% down as seasoned buyers on primary residence. You can do second homes or investment properties require a little bit more down payment. Mortgage insurance is required if you're putting less than 20% down, but it's not permanent. We'll be able to get rid of it down the line at some point. Have the easiest appraisal standards. So if you have a home that's a little bit in disrepair, this is the best program for that. Best used with someone with a credit score of 700 or higher, although it can go down to 680, 660, 640. I mean, you can utilize these programs for lower credit scores, but they work really well for people with a higher credit score. FHA loans are the original loan down payment option loan mortgage product. It's government backed and secured. So you can do as little as 3.5% down, even on a duplex. If you wanted to purchase a duplex, live in one unit, rent out the other unit. Mortgage insurance is required if you're putting less than 10% down. It's permanent through the life of the loan. There's ways to get rid of that down the line. We can talk about that. It has an upfront mortgage insurance premium of 1.75%, but you can finance that. In fact, 99% of the time it is financed in. And so we have a more rigorous down payment standards. And then we have best used with someone with credit score below 700. So if you have a credit score below 700, this is a great program to utilize because you can get a very similar rate to somebody who has a credit score of 700 or higher. So great program for low credit, and then also to minimum down payments. VA loans, we love our veterans. So if you're a veteran out there and you have if you're active duty, retired, and your spouses, this allows you to purchase the property up to 100% financing with no down payment, no mortgage insurance involved in the program. It does have a funding fee determined by your certificate of eligibility. If you are receiving disability, that funding fee can be waived in most cases. It can be used if credit scores down to 620. They have very rigorous appraisal standards similar to FHA. So a property that's in little disrepair may not work as well as a property that's in better condition on these loans. But VA loans are excellent loans, and we love to do those. USDA loans are geared for buyers in rural areas. They're income restricted. There's a debt to income ratio is a little bit more restricted. It allows you to finance 100% of the property with zero down payment. There's mortgage insurance required. It's not as expensive as FHA, but it does have a 1% guarantee fee. Again, that can be financed in. And again, being a government-backed program, there's some eligibility criteria that we need to work through with the government agencies. Down payment assistance program. So if you don't have enough for down payment, we have a program called Chenua, which is the most common one we use. It's available nationwide. The great thing about it is no income restrictions on it. It can only be paired with FHA currently. Credit scores are down to 600. It'll allow for up to 5% of down payment assistance. And that can go towards down payment and closing costs. And there's no contributions from the buyer necessary. In other words, you don't need to bring in a percentage of your own money for down payment. So it's a good program. Jumbo loans. Some jumbo loans do allow for first-time home buyers. If you've never owned a home before, or if you haven't purchased or owned a home in the last 3 years, you'd be considered a first-time home buyer. Then, and if you're looking for a property that is higher priced, some jumbo loans allow that as little as 10% down. Mortgage insurance is required if you're putting less than 20% down, but it's not permanent. Again, much like conventional. Pretty easy appraisal standards, very similar to conventional. Best used with someone who has a credit score of 700 or higher. They don't work real well when you have a lower credit score. And your loan amounts are above the conforming loan limits for the county. So there's a nationwide conforming loan limit, and then there's some counties that are considered what's called high balance, and they have higher loan limits. But once you go above those, you get into the jumbo market. So typically you're looking at loans 1.1 million or higher. So real estate, how to succeed in today's market. Let's talk a little bit about that. So every market's a little bit different. So in Vegas, the property might be worth 585. Similar property in Los Angeles, maybe 810. Maybe in Houston, it's 305. But bottom line is every market's a little bit different. That's where your agent comes in. That's where we come in to be able to help you navigate through the differences in those markets. So it's important to understand the agent's role and to make sure they fit your wants and needs. So when you're looking for an agent, or if you have an agent, or if you need advice about an agent, make sure that they can work with you and how they communicate, what their available hours are, how they spend your information, and whether you can appropriately support you. Okay, so make sure that you're looking also at, do they understand what kind of shopper you are? Are you looking for a starter home in which you can build equity and move forward? Or are you looking for the perfect forever home? So there's a lot of things that as a potential homeowner, when you're looking for a realtor, you need to kind of think through on these things. Now, you want one that know and clearly share your agent wants, know and clearly share with your agent what your wants and needs are at the beginning of the process. I cannot stress this enough. You need to be able to communicate with your agent clearly and let them know what you're looking for. If the agent doesn't know what you're looking for, they can't help you. So the more information you can give your agent, the better off you are, the better experience you're going to have, and the better that your agent's going to be able to help you. So your agent's going to provide you with some questions to help you think clearly through this. One, what is your lifestyle? Who is living in the home? Do you have animals? Do you have specific furniture that needs to be in place? Do you have toys to store in the yard? Are you and who may be buying the home with you? Are you guys on the same page? Are you looking for a specific school district? Is a yard important? There's a number of questions your realtor is going to be asking you. So you want to make sure that you're answering these questions for your realtor so they can best help you. Your realtor is so key in purchasing a house. You really, really need to work with them and give them the information that they need to help you out. Can't stress that enough. Understand your timeline and be clear on what needs to be done and stick to it. So let your realtor know when you'd like to move. When is your leases up? How flexible is your landlord? Do you have a place and do you have a place that you can stay at temporarily? Do you have the funds to break a lease? Remember, your offer needs to be appropriate to the market you're in. A real estate transaction is about compromising. So both sides need to give and take as you work through the negotiation. So be flexible when it comes to negotiating with the seller, and give your agent every opportunity to help you by doing that. So we're going to talk about seller paid rate buy downs. So this is a great, we touched on it a little bit in the case study. So we're going to look at another one real quick here. As the real estate market continues to balance out, we're seeing more sellers that are willing to reduce their price and get a deal done. However, for most home buyers using a mortgage, a price reduction does very little for their affordability in comparison to a seller rate buy down strategy. This is a great strategy to help you transition through the current higher rate market. So let's talk a little bit further about that. It allows the seller to pay your temporary reduction in interest rates. So instead of having the going market rate, you can get a rate that's a point or maybe 2 points lower in this current market for the first few years of your loan. In general, it costs about 2.3% of a seller credit for the purchase price for a 2-1 buy down, about double that for a 3-1 buy down. Your interest rate is reduced by 2% in the first year and 1% in the second year in a 2-1 buy down. After, it reverts back to the no rate you originally qualified at. You should refinance before the end of the buy down period because those funds are applied towards your reduction in principal amount if you do that. So in other words, if the seller is giving you X amount of dollars and we only use half that money, the other half of that money, when you go to refinance, is your money, and you can use that to pay your principal of your mortgage down. So it's a great deal for you. So let's talk about what it would cost, say in Los Angeles, to purchase a property for $1 million, putting 20% down. You'd have an $800,000 loan at 7% rate. If you did a $25,000 price reduction, let's say you said, yeah, I don't want to afford that payment. I want a lower payment. I don't want to pay that purchase price. Let's knock it down 25,000 or even 50,000 or even 100,000. You can see that the payment savings by every 25,000 is about $152 per month. Now, when you get to a $50,000 deduction, it's about $305, and then $100,000, $611 per month. Now, very few sellers are going to knock their price down $100 grand. You know, maybe they'll go 50 grand, 25 grand in this market in LA could be something they would do, but it doesn't benefit you a ton by doing that. If you decided that you would rather take a credit from the seller, there's 3 ways you can apply that credit, either through a permanent buy down, meaning you buy down the rate permanently. And if you did that, you could go from 7% to 6%, and you would save about $526 per month. And that would take about a 3% seller credit to do that. If you had a little bit less of a seller credit, you could do a 2-to-1 buy down. And what that means is your start rate would be 7%. That would be the rate you would qualify at. However, your beginning rate would be 5%, 2% lower than the qualifying rate in the first year. In year 2, it would go to 6% over here, and then year 3 at 7%. So that would be a 2-to-1 buy down. It would save you about $1,027 a month. If you go to a 3-2-1 buy down, you adding an extra year to that buy down, it would take a little bit more of a seller credit to do that, but your initial rate would go down to 4% for the first year. That's 3% lower than the rate you qualify at. In year 2, it would go down to 5%. In year 3, 6%. And year 4, 7%. And it would save you about $1,500 per month. Now, bottom line is you're going to want to refinance into a more permanent loan down the line. We think rates are going to be in the 5% range, as we talked about later this year. And I think going into 2024, we could get rates into the 4s. And if the economy gets bad enough, it may dip back down into the 3s again. The point is, when those things happen, it's our job as your lender to make sure that we are on top of that, to give you the opportunity to refinance into a lower rate at a future time. So before that rate moves back up to that qualifying rate of 7%, we're going to make sure that we're going to help you get into a lower rate down the line. Okay. And then that would permanently set your payment lower moving forward. So at this point, we would ask any questions to the audience, and then again, let the audience know who who's putting on the presentation, myself, and then the realtor. In this case, we're using a fictional Ruby realtor as our broker associate. She happens to work for Compass. And then that would be the end of the presentation. So again, we went through the long version of this presentation. That's the long version of it. This can be condensed down to a shorter version. We can help you do that. If you guys have any questions on it, please feel free to reach out. I'll be able to get you guys this presentation. You can take it out and present it yourself. Or if you want to set up a situation where you and maybe 4 or 5 other realtors in your company want to do a webinar with your clientele, I'd be happy to do the webinar and do the first-time home buyer. Just get with me. We'll schedule that and then get out there and market it and get people onto the webinar. And we can help you build business that way. I'd be happy to do that for you. So either you want to present it or you want me to present it, we can do that. We can structure this accordingly. We can also change the numbers for your market. So when we do case studies, it would be specific to your market, and we can change those things out. There's a lot of ways we can utilize this to help you build business in 2023. I'm here to help you. Just tap into that, and then we can move forward and hopefully growing your business. Next week, we are going to do a rate buy down strategy. We're going to actually dive deeper into the rate buy down strategy. So we touched on that today. This is a huge thing in today's market. So we're going to take a deeper dive into that. So we're going to implement, show you how to implement buy down strategies to turbocharge your business. We're going to take a look at it from a buyer's perspective, also from a listing perspective. So next week, join us. Make sure that you get onto that webinar and make sure that you are adding this strategy to your repertoire this year. It's a really key strategy, especially right now in this current market, to help your clients. So thank you so much. We're give you guys a little bit more time left. So we're just about 5 minutes from our end time. So I'm gonna go ahead and get you guys out of here a little bit early. I want to thank you all for joining, and we'll see you all next week. Talk to you soon.